everybody. I know people are just logging in. We're going to get started here in just a moment. I appreciate you guys coming on for another Wednesday workshop with Directed IRA, Directed Trust Company. If you are new to the program, welcome. If you're a returning attendee, thank you. Thank you for your support. And hopefully these workshops are coming across to you guys as educational, that you're learning something from it. As long as you're taking something away from this workshop, we've done our job. And it's really just to help you guys better understand how self-directed IRAs work, what are some of the options you have when it comes to your retirement assets, and really how you can utilize directed IRA and directed trust company to help rethink and recreate your retirement. And I think it's becoming more and more popular to look at things outside of the stock market for a lot of different reasons. But we're glad that you guys joined us here today. And I've got a great guest on, somebody I've known for a long time, somebody that's invested in a lot of the same assets that I'm invested in. And that's not to say that you guys have to invest in what we invest in, but it is good to understand the different types of investments that you can make. And we're going to be talking about notes specifically, notes secured by real estate. It's one of the most popular investments in self-directed IRAs. Most people think it's real estate. Well, it is real estate. Underlying the investments is actually more passive investments through notes and syndications and other types of ways that people get their retirement accounts into real estate investments. A lot of times it's through the creation or the ownership of notes. So we're going to just jump right into it. And I just want to remind people, if you guys have questions, type those questions into the chat box or the Q&A session. We've got a couple different people that can answer those questions for you. Jared Ortiz, one of our account specialists, he's on there from Directed IRA. Feel free to ask any questions as it relates to self-directed IRAs, how to get them set up, how to fund them. And then once I'm done and Josh is going, I can chime in there and answer some questions too. And we'll have a Q&A session at the end with me and Josh where we can take more of your advanced questions. And if we don't get to all of them, that's okay. You'll have my contact information. You'll have Josh's contact information, and we won't leave you hanging. So you'll be able to ask your questions either on this program or off of the program. So I'm going to get underway here and start with my portion of the presentation. And really, this is just to get people to better understand what a self-directed IRA is, okay, and what it can be used for. So a little bit about myself. I started in real estate back in 2002, right out of college. It was something that I was always interested in. It wasn't until about 2012 that I found out I could have been using my retirement account for something else. I could have been using my retirement account to invest in what I was knowledgeable about, which at the time was notes and real estate. I worked in the lending field. I was a mortgage broker. I understood my train of thought was real estate and lending. And it wasn't until 2012 that I even found out I could have been using my retirement account to invest in what I was knowledgeable about. For 10 years, I had a retirement account invested in stocks, bonds, mutual funds, because that's what I was taught to do. I assume a lot of people were taught to do that same thing. And I think nowadays, based on the growth in the self-directed IRA industry, I think more and more people are realizing you don't have to invest in the stock market. And I'm not calling the stock market bad, but you don't have to invest in the stock market if it's something that you don't understand. There's a lot of things that you can invest in when it comes to your retirement assets. And that's where we come into play. You'll hear this term a lot on our program. Specifically, we're going to be talking about what's called a self-directed IRA. Now, if you're a client of ours, you already know what self-directed means. But most people do not know really what the term self-directed means. How is a self-directed IRA different than my IRA, my rollover IRA, my old 401k? What is different about a self-directed IRA? The simple answer is nothing. Self-direct is just a marketing term. There's no legal distinction between self-directed IRA and IRA. General rule of thumb, IRAs are IRAs are IRAs. IRAs are all governed by the same set of rules. Doesn't matter if you have it at Fidelity, doesn't matter if you have it at Wells Fargo Advisors, doesn't matter if you have it at Directed IRA. That IRA follows the same set of rules. So why can you invest in things like real estate notes with Directed, but you can only invest in stocks and bonds with Fidelity? Has nothing to do with IRA rules. It has to do with what that custodian is set up to manage or hold. Fidelity's and Charles Schwab's, they're only going to allow you to hold public assets, traditional assets. Why? Because they're licensed securities brokers. The nature of their business is to buy and sell public assets. They're not going to allow you to use the IRA there held at Fidelity to buy things outside of that. Okay, it's just the nature of their business. Doesn't make them bad guys. It's just what they do. When you have an IRA at directed IRA, our account agreement with our client says we'll allow you to invest in anything the IRS allows, but you have to pick the investment. And when you look at the IRA rules, the IRS does not tell us what we are allowed to invest in. They only tell us what we're not allowed to invest in, and the list is really short. There's only two things you're not allowed to own in a retirement account: life insurance contracts and collectibles. That's it. Those are the only two things the IRS says we don't want these in a retirement account. So anything else is fair game. General rule of thumb, if you can hold title to something, the title of that asset can be owned in the name of your retirement account. You just have to find a company that's willing to buy that asset in the name of your IRA, hold that asset in the name of your IRA until you're ready to start taking distributions. So again, our account agreement gives you a lot more flexibility to invest in what you know best, but we're not going to sell the investment to you. It's going to be in your hands. And that's where the term self comes from in self-directed, is that you truly have the keys in your hand when it comes to picking your assets. Now, I will say on the flip side of that, doesn't mean a self-directed IRA is right for everybody, because if you think that you're going to move your Fidelity IRA here and you're going to just all of a sudden make a bunch more money, well, it depends on what you are having us invest in, because we don't have a menu of investments for you to choose from. We don't have a menu of homes or a menu of properties or a menu of notes for you to buy. And this is where this education comes into play, is to help bridge the gap between your idle self-directed retirement funds and how to go find some of these alternative investments. Okay. So here's just kind of a visual of what most people invest in. On the left side, stocks, bonds, mutual funds, CDs. Here's some of the things on the right-hand side that we see our clients at directed IRA invest in. We see them invest in rental property. That could be fix and flips. That can be buy and hold. They invest in commercial property, private equity, private stock, syndications. A lot of these syndications own apartment buildings. These are all what we consider alternative assets. And then what we're going to be talking about today and on the next couple programs actually is notes, loans, and a lot more. So remember, you're only disallowed to own life insurance contracts and collectibles. Anything else is fair game. I will tell you, most of our clients at directed IRA don't just have an IRA at directed. They still have an IRA at Fidelity. Okay, why would you want to have an IRA at Fidelity and an IRA at directed? Well, first of all, you can have as many IRAs as you want. But the benefit to doing that is you have true diversification. It's not bad to own some of your assets in stocks and bonds and those types of things, but you might want to look at having some of your assets in alternative assets. And the reason being is a lot of the alternative assets we talk about are more tangible than, say, a stock. Stock, for example, you can own a stock in a company, but if that company goes bankrupt or belly up, what are you left with as an investment? Well, you're left with nothing because there's no collateral with that investment. We're going to be talking about notes today, and notes is an investment I personally enjoy and I personally like, because even though it's a paper asset, a promissory note, my paper asset, whether I own it inside or outside of an IRA, that paper asset has security. The security is the property that loan is secured by, or that note is secured by. So at the end of the day, if my borrower stops paying on that note, I do have collateral. Okay, it's not like it goes bankrupt. I do have collateral because I have the house. Not that I want the house, but that's something different, fundamentally different with that type of paper asset than just owning stocks. And I think most people, as you get build more and more wealth, and we actually see these from the numbers, is that as your IRA increases in value, the people that have big chunks of money in their IRA, they start gravitating more towards alternative assets. Why? Because they're tangible. Okay. And at the end of the day, it's a good hedge against anything that's going on in the stock market. So you don't have to be a real estate investor or a note investor to make it make sense to have some of these alternative assets owned in your IRA. But again, you can have as many IRAs as you want, held at different places, holding different types of assets. Here's the types of plans that you can use specifically at directed IRA, that you can own notes and own real estate and own syndications. And these are the same types of plans that you can have elsewhere. So remember, don't get confused on the term self-directed. We have self-directed traditional IRAs, self-directed Roth IRAs. Again, self-directed is just a marketing term. If you're self-employed, you can self-direct a SEP IRA or a simple IRA, or even your own solo 401k, which is a lot of our small business owners use solo 401ks as their self-directing vehicle. And there's two accounts that we don't talk about enough, and I'll do some classes on these down the road, but you can also self-direct accounts that aren't retirement accounts, and that would be your health savings accounts and your education savings accounts. Now, these are not retirement accounts, but they are tax-exempt trusts, just like the other ones, that can be self-directed and you can buy alternative assets. The difference is the benefit going back to those accounts, whatever, if it's the interest income from the notes that it owns or the rental income from the homes that it owns, when you have an HSA or an ESA involved in that type of ownership, well, the profit gained in those accounts can be taken out immediately to pay for health expenses for you and your family, and pay for education expenses for your kids. And that could be education expenses all the way from kindergarten through college. So there's a lot of different avenues where self-directed IRAs can help you, not just in retirement, but today as well. And I'll just give you my own personal example. I like to create notes, and me and Josh will talk a little bit about that. Buying notes and creating notes, a little bit different, but it's still a note. But any of the notes that I create, I usually have my Roth IRA as a part owner of that note, my HSA as a part owner of that note, and my ESAs for my nieces as a part owner of that note, because when my borrowers make interest payments back on that one note, I've got part of those interest payments going back to my retirement and my self-directed Roth, and I've got some of the profit going back to my HSA and my ESAs, and that money can be used today if I wanted to pay for qualified expenses. So when you look at these plans, what you want to think to yourself, even if you're a client, I will tell you, I have never found it beneficial for a client to have one account. If you have one account, you're missing out on maybe 6 other opportunities to grow tax-free wealth. So when you're looking at this, you want to think to yourself, how many of these plans can I have? Because each one of these plans here is not a taxpayer. So every dollar you can put inside of one of these plans and self-direct it, the less money you're going to have to pay to Uncle Sam at the end of the day. So that's just kind of what I want to talk about, is how do you self-direct? Okay, what are the powers of self-direction? What types of plans can you self-direct? And as we go through this, I'll talk a little bit more about this. If you're not familiar with the process, how do you take an IRA and start investing in things like notes? 3 quick, easy steps. 1, you got to set up an account with a company that will hold the assets you're looking to buy. And if you're looking to buy notes, directed IRA will hold that type of asset here under our custodianship. So first step is set up an account. Okay. I've got one of my, I mentioned earlier, Jared Ortiz is one of my account specialists on the line. He can answer any questions, and he can help you set up accounts if you haven't set up one before. Number 2, once you get the account set up, you fund it. You can fund it with a transfer from one of your existing IRAs. You can fund it from a rollover from one of your old 401ks, or just any other type of account that you want to move over. And once that account's set up and funded, we have a transactions department that will help you process the investment, not identify the investment, process the investment. And this is hopefully where some of this education comes into play, is how do you find alternative assets if you're not familiar with doing it, outside of your IRA. So let's bring on Josh. I want to talk about a little bit about notes and bring him on. I saw his slides. He's got a great presentation for you guys with case studies too. So actual real life examples, which is something that I love. And Josh is the author of Paper Profits, which if you haven't read that book, it's a great book. And if you want more information, either on this program or outside this program, they've got a great website, Paper Profits, paperprofitsinvestors.com. So Josh, welcome, and thank you for joining us.
Hi, Nate. Thank you so much. That's a tough act to follow. You had a lot of good information there, and I'm excited. I'm excited to talk about this with you.
Thanks.
So,
And again, I remind people, ask your questions. As Joshua is going, I'll try to answer some of them if they're related to us and so Jared, but we're going to take some questions at the end here too. But Josh, go ahead and take it away.
all righty. Let me adjust my screen here so I can see. And can you see me all right? Yeah.
Yep.
Okay.
See you.
Okay, so thank you everybody for being here today. I'm excited to talk with you. And what we're going to talk about today, like Nate had said, is notes. And I'm going to explain a little bit about my background very briefly, kind of what I've been involved in as far as investing, alternative investing. I very much believe that alternative investing gives investors like ourselves a lot more choice, right? So we're not pigeonholed into just the stock market, just mutual funds, things like that. Again, not to say those are terrible, but it gives you more options. And I think that having a company like Directed IRA really gives you as the investor more tools, right, to grow your retirement. So that's what we're going to be talking about today, how notes is something that you may consider as part of your retirement strategy and as part of your investment strategy. So my name is Josh Andrews. I'm with Paper Profits, and this is our information here. I'm based out of Austin, Texas, and my partner, Jane Wobbs, she's not here with us today, but she is an integral part of our operation. She's a licensed CPA and has been just doing wonders for us, helping us grow. I've been investing for since 2012 in this specific asset class. So I have a lot of experience in this, and I'm going to share with you things that I've learned and a lot of the common questions that we get from investors and things that pitfalls, as well as things that I think you can help leverage your money or really grow your money in your self-directed IRA. So a little bit about me. I began, like I said, investing in mortgage notes in 2012. And in fact, I actually did use that money from my IRA. So I had a self-directed IRA at the time, and I used, I think it was about $19,000 to buy a performing loan. And we'll talk about what that means and kind of what that looks like. But that's how I got my feet wet, right? And I wanted to see what it was like, really understand the business and see if this was something that I was interested in from a risk reward scenario. So I also have worked as a loan originator for 2 banks. And what that means in simple terms is I was just helping folks through that bank create loans and or modify loans. So like not necessarily modification, but refinance, things like that. So I was interfacing with borrowers, looking at the numbers, working with them in their application, things like that. I also authored, like Nate has mentioned, a book in 2017, and it's called Paper Profits. That's actually what we've named our company after. And the book itself is just a primer, an educational book. The reason I wrote it is I wanted to be able to explain to a layperson, say my family or someone, what it is I do and what the opportunity is, so they could understand that in simple terms. And so I created that book, authored it. It's on Amazon. It's been there for a while, but I'm also going to give you an opportunity to get a free copy of that if you would like. We're more than happy to send that out to you. It's a physical book, and we can just ship it out to you. So I'll explain a little bit about that. So I have extensive experience in this asset class. I have personally purchased and sold right around $50 million of unpaid balance. And what that means is that's not necessarily a purchase cost or out-of-pocket cost, but that's the amount of unpaid balance on loans that I have transacted since 2012. So it is substantial. So I've seen a lot of stuff that have gone, it's given me enough time to see what works and what doesn't. And also the risk reward scenario, which is very, very important when you're investing, especially as you're self-directed. You're taking a more hands-on approach to actively choosing the types of investments that you want in your IRA. I began my first fund, which is essentially a pooled investment in raising capital in 2018. And I'm a full-time investor. I live in Austin, Texas, like I mentioned, and I did include a couple slides here of my wife and I on a recent trip. And then my favorite pal, my dog, her name is Ava. And before we had this dog, I used to think of pets as just pets, but she kind of won me over, and this is actually family now. So the things that I value, the reason I got into investing is obviously we do it to make money, but usually there's an underlying, more important why when someone goes above and beyond and tries to do something. And identifying that, I think, is very important for us as investors. For me, mine is health. I think without health, everything else kind of falls apart. Freedom, so that means freedom of choice, freedom of your time, family, people that are close to you, and then just time to think. I think that really time is the only true, not the only, but one of the biggest luxuries that we can have. And money and investing gives us time, right? So to live the type of life that you want. So that's identifying what's important to you, I think, is very important and gives you kind of legs to get through the tough times when you're investing. So if you go to our website, it's paperprofitsfund.com, paperprofitsfund.com. There's a form right on the main page. You can get a copy of my book. All you have to do is fill out your information. We're not going to hammer you with spam or anything like that. It's a physical book. We'll ship it out to you. And if you do want to have a consultation or questions, I'm more than happy to have that with you as well. So let's get right into it. Let's talk about notes, and we're going to take kind of a 20 or 30,000 foot view here, because just like any other topic, whether it's any type of investment, you can really, really get granular and drill down. So we're going to kind of take an overview today. We're going to chunk down into some other topics on this topic, but I say this just to preface, we're not going to discuss everything note related because it would be very difficult to do that inside of 45 minutes or so. So with mortgage notes, one of the reasons that I believe personally that this is an ideal fit for self-directed type of accounts is you're the lender. Like Nate said, you're the lender, you're the bank, the cards are stacked in your favor. And what I mean by that is whether you originated a loan, which we'll talk about, or whether you purchased a loan that's already existing and your IRA owns it, you're secured. You're a first or sometimes second position lien, you're a secured lender. And what that means is you have kind of an option, a cash flow stream that's coming from this, but it's not just a piece of paper. It actually has a physical property, real estate, that's hopefully appreciating, that has tangible real value that you can touch, that's backing that investment. And so you have a legal claim to something on title that people value, people the world over value. So unless the property is just an absolute dump or you made a poor choice, there's always some demand for that. You have a predictable stream of income every month. So this was one of the things that I was very excited about and still am for this type of investment, because I like to chart things out and plan. And with retirement accounts, I think that's very important because you have a set number of years before you're going to need to access your funds. So knowing approximately, give or take, how much money you need to get where you're going and how long that's going to take you with your resources is really important. Now, with this, you're getting very consistent payments each month, which we'll talk about. And because of that, you can chart out, okay, this year, my IRA is going to make this much money, next year this much, et cetera. And so you can literally decide, hey, I need to buy X many more of these loans or reinvest this money at this point, right? So it's not really a guessing game. You can also be very realistic with yourself and say, hey, I'm going to fall short, or this is going to get me there earlier, maybe. You have none of the headaches of owning physical property. So real estate is a wonderful investment tool. This is closely tied to real estate. So again, you have all of the security from the real estate, but you don't have any of the hassles. You don't have the tenants, you don't have the toilets, you don't have the headaches, you don't have to worry about very little It's virtually hands off. And you really enjoy truly passive income. So that's the draw for this type of investment. Is it's not speculative. It's something that all of us can understand. At the very basic level, you can obviously invest in all kinds of real estate or notes that are associated with real estate. But at the very basic level, you can do that on single family homes. And you and I, as investors, we can relate to that. We live in a home or a condo or something. And so that's something that has value that we understand. And so that is one of the things that makes notes very, very attractive, and especially to hold in your IRAs, because it's passive and you're secured, right? It's very consistent. So how much can you make? And like a lot of things, this really depends. You can, it depends how much risk you want to take, right? There's all kinds of different notes out there. And when I say notes, I mean, it's kind of an interchangeable slang almost. So you have a mortgage, which is a security instrument, or the note, which is kind of the IOU, but they both are the same. You're purchasing both or own both of those, right? So when I say note, mortgage, loan, we're kind of talking about the same thing, which is a mortgage or deed of trust. Someone owes you money, your IRA money, and they're paying you every month or every quarter, however it's structured. So performing loans are loans that are paying as agreed. So if we have let's say I have a mortgage on my property or my home, every month I'm making a payment to the mortgage company or the servicer, and that means it's paying as agreed. Now, if I stop paying, it'll fall into what's called a delinquent status. And then after that, if the time has passed enough, it will go into defaulted, which means I've completely, stopped paying on my obligation. And then now the loan is not producing income for whatever investor owns that loan. So obviously non-performing loans or performing loans are much more stable, right? You rarely have issues with those. Those are the most passive. And generally speaking, these are loose terms, you're going to make around 9 to maybe 12% annualized on your money. So what that means is, you're going to outlay some money, and then every year you're going to be earning interest on that. You're going to be getting a return. The nice part about that is you're getting that monthly. So you're getting pieces of that monthly. You're not waiting to a certain point. So if you have an investment where you can actually utilize those smaller chunks of money that your IRA is getting every month, you can reinvest those right away for a higher yield. And that's something we'll talk about. So non-performing loans are loans that, like we talked about, have stopped paying. And these might have stopped paying for a few months or years. Now, you can earn a lot more from those, but it's a different animal. It is not this passive type of strategy. It's more or less where you're buying these at a discount because there's something wrong with them. The borrower's not paying, they're dead, a number of things. And then you're going in and you're fixing this. So this is more of like collection work, foreclosure work, things like that. That is not a place to start and not a place that I would recommend. We have a lot of experience in the non-performing arena as well as the performing. So I'm very aware of what it takes to go through that process. And it can be very lucrative, but it's not a place to start. It's definitely something that takes a lot more hands-on, and you have to be able to tolerate risk. So with the compounding, essentially, the idea that I want you to take away from this is if you can find a vehicle where, let's say, you're earning 9, 10, 12% annually on just a boring loan that's performing that your IRA owns, and you're getting those payments every month. If you can compound those, that's how you really take off. If you can compound those, and on this chart here, we have a number of different ways to compound that. And we can talk about that if you want to reach out to me. It's really not that difficult, but you can get well into the teens annualized. So talking about steady and predictable income, this is just a screenshot from a loan in one of our portfolios. And you can see on the left-hand side, there's a few day variation, a few days, but basically This person has it on ACH, where it's automatically deducted from their account, this borrower, and it just pays every month. It's just boring. It's just every month you're getting $785.62. And so with that, like I said, you can chart out, where am I going to be in a year, 2 years, 5 years, if I have stuff like this. Now, keep in mind with loans, you can also sell them. So you're not committed to, if this borrower, this example, let's say they have 15 years left on their loan term, you're not committed to holding that. You can, but it's not like, wow, I'm stuck with this thing. You can enter and exit these investments fairly easily. It's very liquid. So you can, let's say you put up a chunk of money to buy a loan, your IRA did, and 2 years later, you find a better investment or something else. Maybe you need the cash, maybe you're ready to retire. You can sell this for whatever the unpaid balance is. You can sell this loan for cash again. So it's this kind of golden goose that just keeps producing income. And there's a number of ways to do that with performing loans. So with, like I mentioned, with compounding, what this really allows you to do, and one of my favorite parts, is it allows you to plan your retirement better. It allows you to see into the future and say, okay, as long as this borrower keeps paying and everything is as agreed, this is what it's going to look like after a certain period of time. And like we had talked about, if you can compound, whether it's yearly, quarterly, you're going to get there a lot faster. You're going to grow your money a lot faster. So compounding just simply means, let's go back to our example. Your account is receiving this $785.62 every month, and it's probably not large enough to make another investment unless you have something already lined up. You're like, it's just going to sit there until you have enough to buy another note or place it into another investment. Well, if you can find a way to compound that, so in other words, immediately put that $785.62 to work, which you can. There's definitely methods, and I can share with you methods to do that very easily, passively. That's how you're getting this type of growth, right? Because it's just being compounded and it's taking off. And you're not really doing anything. You're just checking your account, making sure everything's fine, and it's chugging along. Now, we talked about if the borrower doesn't pay. Now, that's a whole nother type of scenario, right? A lot of folks are afraid of foreclosure, and I don't want to do all of that. I'll tell you up front that the typical rate of foreclosure, and I mean not where somebody just stops paying, but where you have to take the property back, on most portfolios is 3 to 5%. And what that means is if you had 100 loans that your IRA owns, 3 to 5 of those, you're actually going to have to finish the foreclosure and take the property back and sell it, right? So it's a very small number. It can happen. If you buy one loan, maybe you get unlucky in your first loan, that's what happens. That's certainly possible, but it's not a regular thing. I know investors who have had very large portfolios and almost nothing. So when that happens, let's say you cross that bridge and a loan stops performing, there's a whole host of methods that you can use where you're not taking your time, you're having an attorney handle everything. And in most cases, you're going to recover your money or make money in that process. A lot of times you're going to make money. So it's not something to get hung up on. This is a very rare occurrence, but that's actually what you use as a lender, your security, right? Your security for whatever investment you've made is that property, that collateral, which is appreciating, hopefully.
Hey, Josh, had a question come in. I kind of answered it, but I want to get your take on it too. And this, I guess, is more for on the creating notes portion, which I know you do some creation of notes. You do some lending as well as buying notes. Yeah. And I'll just read the question as is so you can kind of get your take on it. But it said, you mentioned performing notes are 9 to 12%. If somebody is willing to pay higher for a bridge loan for a flip on a second lien position, which is slightly more risky, is there anything that stops you from charging 30 to 40% annualized on that note as an interest if somebody's willing to pay it? I know the answer, but I'll let you fire away on that.
So it's going to depend if the property is commercial or residential, right? If it's residential, you're not going to be able to charge somebody that amount of money. There's usury laws and there's some other things. It's also going to depend on what state the property, the collateral is located in, right? Certain states have certain requirements with regards to how much interest you can charge.
Yeah.
Now, that being said, we as lenders want to charge as much as possible. And you will see a lot of very high interest rates with bridge or very short-term type lending. And what that is essentially is we're not talking about a 30-year fixed with ma and pa in the house. You're just talking about, I need, X amount of dollars to get from here to a year or 2 years or 3 years, and then you get all the money back plus interest. So, we've originated loans in the teens, right? 13, 14, 15%, but very secure collateral. So I wouldn't be afraid of second position liens. That's actually where I started my business. And the thing you just need to understand is you need to really have a good picture of what the equity is in the property. It needs to be very generous. You need to understand the status and the unpaid balance of whatever seniors ahead of you. And you need a way to monitor that. So if for some reason the borrower stops paying that senior, you need to be able to immediately step in and do something to protect your money. So that just requires some wherewithal. But if you are taking a second position lien, I would certainly charge higher interest, not 9 or 10%, because there's certainly more risk there.
Yeah, and from my understanding, and again, I'm speaking from experience. I'm not speaking from like an attorney standpoint or anything like that, but you're not going to go to jail for charging somebody 30 to 40%. They could even agree to pay it. It's just that contract could be voidable if it's considered a usurious loan, if you're charging more than what above the state permits. And most states, I would say, I think 18% is usually the max you can charge on, on loans secured by real estate in most cases, if it's not commercial. Yeah.
Yep.
So
yeah,
it doesn't make it bad.
Commercial's whole different thing where they default and it goes to 24%, and
right. Now, I will say this real quick, and I don't know if you're going to touch on this, but one of the things I'm going to talk about in the next class is actually shared appreciation notes. Shared appreciation, you could have a note where it maybe it's not charging high interest rate, but it could have an equity kicker on it. Now, your equity kicker, depending on how good the investment is, could exceed 20 to 30%, but it's not considered charged interest because now you're part of the risk. So that's
Right.
one way to make above 20 or 30%, but you have to put yourself in a position where you're part of the risk, because it could go the other way too. But that's another strategy for another day.
I'd like to see that. Yeah, I've heard of it. I've seen a couple government loans that we were involved in that we purchased on the secondary market that had that, where they had a shared appreciation, but I've never seen an actual investor do that. So I'd be very interested in seeing that.
Oh yeah. I've done one myself. So yeah,
That'd
join in next on the first.
I'm in. I'd like to see it. So like Nate had talked about, we're going to talk a little bit about the types of mortgage loans. Now, we're talking about originating loans and the secondary market and discount and yield. And so what is all that? So originating a loan simply means the creation of. So whether this is a private loan, you're just doing like a hard money loan, and hard money would typically be like a bridge type loan where someone's doing a fix and flip. They need money to buy the property, do the repairs, and then sell it for a higher amount. Or maybe like in a lot of cases with commercial type property, like a bridge or hard money would be, they just acquired or they're doing upgrades to the property. And once those upgrades are done, they can get a normal loan from the government, like a Fannie Freddie loan, much better rates, much better terms, but they need to get from here to there. And that term might be 12 months, 14 months, 2 years, something like that. So originating a loan would be where we create it. We do, or your IRA, does the actual origination. So you do the underwriting, you would verify all the borrower's financials, you do all of that. So it's a little bit more work up front, But typically when you do that, you get to control the process more, right? Because you can turn stuff away that doesn't meet your criteria, and you have a little bit more control over exactly what rate you can charge and other variables. So it's a great way to go, especially in this type of environment now where we have interest rates going up, right? So if you're originating loans, you can keep pace with that increase. Like I said, you can, like right now in today's environment, I know a lot of folks that are originating loans, 10, 12, 15%, right? And then they're getting their money back after a couple of years. So you just have to understand how to do that. And there is some legwork involved there. You also need to understand if you're doing this on residential property, there's a whole host of laws that protect consumers. So you can't just do anything you want. You have to really understand that. And I would recommend hiring an attorney to help you advise and create or originate those types of loans. So with origination, typically what you're looking at is from the investment side, you're looking at the yield, which is the return that you're receiving for the money that you put out on an annualized basis. That's what you're looking at as your return. And usually there might be some points, which would be just a percentage. Typically a point is 1% of the loan balance. And that would be something that you might collect up front, depending on the arrangement that you had. So kind of like a little sweetener up front. There's no discount, and we'll discuss what a discount is. So on the secondary market, or if you're buying a loan at a discount, which you might hear a lot, that's on a secondary market. So what that means is someone else has originated a loan, typically a bank or credit union or a private individual, and then at some point they sold it, right, for whatever reason. And now it's for sale, and you end up buying that. Well, you're going to buy that typically at a discount. So now there's two different factors that you're looking at for a return. You're looking at your yield, which should be the primary focus. And then you also have kind of a sweetener, which is the discount. And we'll discuss exactly what that means and what those look like in a couple examples here following. So I'm going to get some water here. So again, yield is the return that you're earning per annum or per year. And then discount is the purchase price divided by the unpaid balance, or UPB, expressed as a percentage. So we'll go through a couple examples. So again, the discount is only going to apply when you're buying a loan that's already been originated. It's on the secondary market. You're not the one creating the loan from scratch. So in this example here, this is an actual loan that we purchased in the portfolio. The unpaid balance, or the UPB, was 144, rounding up, let's call it 145. So the purchase price, this would be the out-of-pocket investment, was $118,000 and change, right? So that's your basis, your cost basis. So how do you determine what your actual return is? Because you paid less than what the borrower owes. And then also the discount, how does that play into it? So the yield on this is 15%, and I'll talk about in the next slide how that's calculated and how to look at that. And the discount is 18%. So the discount expressed in dollars is $26,244. So the discount, basically, if you add the 26,000 to the 118, you get the total unpaid balance, right? So that 26,000 is 18% of the total amount owed, if that makes sense, without getting into the weeds. So here's how you figure that out if you're buying, right? So again, this is a loan that's already been pre-created. Someone else has originated this sometime in the past. You're just buying it for cash flow in your IRA. So you have on the left side, you have the borrower's amortization, and this is what they are paying. So this is all the borrower knows. This is, they have no idea of any of your side of it. This is just what they're paying. And on this one, it's a high interest rate, right? So we're at 10%. And we can see here what they owe and then what they're paying per month and the number of payments left. And then on the right-hand side, you have the buyer amortization, or what you are earning in your IRA. And this number obviously can be any number, right? So the higher the better, but obviously you're trading risk for return. You still want it to be passive and safe and hands-off. So typically this number is going to be in the 9 to 12% range. 15 is a little bit high for your average transaction unless you're doing this full-time and you really have a pipeline of things going on. So on here, you can see that we paid $118,748.60. And what this does is, this is just amortization software. So it just, you put the numbers in and it pumps out exactly what you should pay to reach your yield that you want. So let's say you had a yield, I need to make 11% annually in my IRA to get from here to there. I want to be conservative. So you would put that number in, and this software would tell you exactly what you need to pay or buy this asset for to produce that yield. And then you would also look at your discount. So the discount is something that's kind of a sweetener. You don't want to focus on it. And the reason for that, going back to our example, so you see the discount is 18%. So it's like you're buying something at 18% off. Well, this borrower the only way you're going to actually see that extra 18% or that extra $26,000 is one of two ways. If the borrower pays all the way to term, right? So pays every month until the whole term, which I think on this one is 120 months, which is fine if you're good to wait for that, or if they refinance or they sell the property. So if they do either of those things, then they're just going to pay off the unpaid balance and you're good to go. So what would
Josh, sorry.
I see you there. Yeah.
No, great point. I just want to make this, let me just look right into the camera on this. For self-directed IRA investors, when you see a deal like this, where you're making money on the buy and you're buying something at a discount, the thing that should automatically pop into your head is Roth conversion. If I'm looking at this deal and I've got a big traditional IRA, if I buy this discounted note with a traditional IRA, and let's say exactly what Josh says happens, they pay off the note, they pay the term, which usually doesn't happen. Usually what happens is they upgrade to another house, they get a refinance, or a new buyer is going to pay off that existing note. Well, that's when your profit's going to kick in. If you bought that and profit from it in a traditional IRA, well, it's a great investment still, but you're going to create yourself another $30,000 in taxable income. You just don't see it until you take distributions. So this is where it gets fun for self-directed IRA investors, where you can't really do this in the stock market. Is you identify an investment that you're buying, making money on the buy. Think about paying the taxes on for instance, $118,000 first, buy that note in your Roth IRA, and when it pays off, you've got $144,000 tax-free. That's the only point I wanted to make. So.
No, that's a great point. And I think that's one of the reasons these types of vehicles make such a great pairing for self-directed IRAs, right? There's a lot of really cool stuff you can do with these. Yeah, so getting back to that, really, the discount is important, right? Like Nate said, you would get paid this discount either once the loan gets to maturity, when it's fully paid off, you'd realize that over all of these payments, or if they refinance, sell the property, et cetera, you're going to get a lump sum. And that's nice because if that's in your tax advantaged account, you're not going to get taxed on that. So, you use software to figure this out. It's very easy. There's a very easy learning curve to it. The trick with these types of things is finding the correct note to buy, really understanding a lot of the due diligence process. Don't just go out and buy the first thing you see, because that's going to obviously lose you money. You can lose money. There's a learning curve to it, but it's definitely accessible if you want to be hands-on. So here's an example of why you should always buy based on yield. Now, this is another property or another note that we purchased. Now, we did not purchase at the example yield that I'm showing you, but I'm just showing you real numbers to show why you shouldn't focus just on discount. So discount's nice, but it's extra. So the yield is all that matters. The yield should be something that you're focusing on because that's the return you can chart out, that's more predictable, that you can actually depend on. Like we talked about, you don't know when you're going to get the discount. So it's something that's nice, but not a sole focus. So in this example, we have a property. The unpaid balance is 103, let's call it 104,000. It's very close. The rate is just over 4%. So we did not originate this loan. We inherited it. We purchased it. The rate at 4% is all the borrower knows. We can't change that. We can't push it up. It is what it is. So with this, if I am just focused on the discount, what's going to happen is it's going to hurt me in the actual yield, because what's going to happen is we've got the borrower is paying just a little over 4%. I'm paying 80,000, right, on the right-hand side here. So I'm actually getting pretty close to a 23%, or exactly a 23% discount. And that looks great. And you can actually have loans where you're getting a 40, 50% discount. It's like, wow. But if the borrower never pays off, or if they have 20 or 30 years left, you're really not going to realize that for a very long time, if ever, or until they hit maturity. So what you should be focusing on is the yield, because in this example, even though you're getting a 23% discount, you can see that you're only earning just a little over 6%, right? Which you're still ahead of the game, but it's not really enough to get excited about. So what's affecting this is, going back to our original example, is really the term and the interest rate. So what the interest rate the borrower is paying. If they're paying a higher interest rate, you can reach your yield with very little of a discount, right? You don't need to pay as much to get where you're going. So always focus on the yield, and then anything else that happens with that loan, like a discount, is just gravy. It's extra. So let's talk about why someone would sell a loan. And I get this question a lot. There's a number of reasons, and it doesn't mean that there's something wrong with the note. So banks, credit unions, private sellers, private originators sell loans all the time. There's a huge market for that, and they're very liquid. And a lot of reason is simply because they need the cash, right? They've held this loan for 4, 5, 10 years. They've received a ton in interest, and they're going to sell the loan. They might even sell the loan for almost what they bought it for, right? And then they've collected interest for 5 or 10 or 8 years, and then they sell it for very near what they bought it for. You as the buyer have no idea. You're getting the return you want, the security you want, and everybody's happy. That happens a lot. So they might need cash for a life event. They might need cash for a different investment. It's a hot investment they need to get into right away. And so that's what they do it for. They might do it because it's non-performing. Maybe this is a loan in their portfolio that has stopped paying, or that is what's called a late payer, where it's just hit and miss, and they're tired of it. They're just like, I want to get rid of it, and I want to put this money into something else. And another reason is because they need to recapitalize. So funds like ours, who raise money and use the time value of money and velocity of money, you need to recapitalize, meaning you're going to go into one investment vehicle or a note or a pool of notes. You're going to do what you need to do according to your business plan, and then you're going to exit and reuse that money and keep kind of ratcheting up. And so recapitalization is what a lot of businesses or professional investors do. You don't need to do that in your IRA. The simplest way is just to buy a performing loan or invest passively with a fund or something like that, and just let it ride. That's the easiest method. Talking about pricing a loan. How much should you pay? What factors go into that? This is kind of a complex discussion. So this is something that we could do a whole nother slide on, or a whole nother conversation on, along with due diligence. Due diligence is a very important topic. So a lot of the things that are going to affect or determine what a loan is worth, whether you're buying it or you're reselling it, is obviously the property condition, the security of the collateral. If there's no security, or if it's a vacant lot, or if the property is boarded up, or a number of other things, that's not a great loan, and for a number of reasons. You're also going to be looking at the borrower's strength. So if you have the loan documents, their application, all of the things that they had filled out, maybe the HUD-1, all of that stuff, their application, all of that stuff is going to matter. And so you want to really scrutinize that. Factors of what the loan is worth include, like we looked at the other examples, the rate that the borrower is paying, which is called the face value or the face rate on the note. The higher that is, in very simple terms, the more that loan is worth. So the less of a discount that seller has to give, or the less of a discount you would pay as a potential buyer. The loan terms, how soon it needs to be paid back. So one of the things to keep in mind with loans and investing as a lender is the time value of money is very important. And that's where compounding comes in. Time value of money, if you have a loan and let's say you invest money and you're getting a return and you get it back in 2 years versus you get it back in 10 or 15 or 20 years, all things being equal, you want it back sooner, right? Because $100 today is not going to be worth $100 10 or 15 or 20 years from now. It's just not going to buy the same amount of goods and services. And so that's where the time value of money comes in, and understanding that factor. Just because someone owes you an extra $30,000, if you don't collect that for 25 years, I mean, it's almost like not worth anything at some point, right? The farther it gets pushed out into time. So the closer that is, the better. Now, you don't want to be where things are so close where you're just on this constant mill, you're on a constant hunt for the next loan, right? So there's a sweet spot to be found in there for your IRA. And price is kind of a function of the yield that you need. A lot of investors are conservative, which I think is important with IRA funds. Maybe you have a bucket for a more aggressive approach, and then or growth, and then you have more of a bucket for income. And so price that you're going to pay for something kind of comes down to what yield you need. And there's a trade-off to be had for a yield that's keeping you ahead of inflation, all of these things, but also providing security, right? A very nice property, very clean, good borrower, all of those things. So there's a bit of a trade-off, just as with everything in life. Due diligence, as I mentioned, is a huge thing. Due diligence is really the effort that you're going to take, and the steps, more correctly, that you're going to take to verify the details of this loan, that they are what you think they are prior to purchase. And we could do a whole nother workshop or presentation on due diligence because it's a very in-depth topic. So what I would say is take that slow. If you're hands-on, that is the most important part of the whole thing, is the due diligence, right? Because after that, you're pretty much passive. It's in your IRA, you're hands off. Due diligence comes down to assessing risk, assessing if things go bad, like a worst case scenario, how will I handle this? So you kind of tee that up in advance, and really just going through the steps and understanding what you're looking at. So title, all of those things, the documents. If you're more passive, right? So we have a lot of investors that we work with in our funds where, they're very educated and they just don't have time or the inclination to do all of that, right? And so that's where passive investing with another partner or with another entity comes in, which is our specialty, which is what we do. And then some tax considerations. So I'm not a CPA, and there's a lot I don't know, I will admit that. Tax considerations for this specific asset class, it's ideal to have inside of self-directed. Typically, these are all cash transactions. So when you buy a loan or make an investment into a fund, you're using cash. You're not using leverage or another loan to fund that. The monthly interest that you receive from a loan is going to be interest income, obviously, like the name suggests. So that's how it's going to be reported if there was a taxable event. If it's in an account where you don't have any tax either in the future at all, or it's way in the future, like a deferred account, That's when it'll be dealt with. Income from an early loan payoff. So in those examples where you had a discount and the loan pays off early and you get that discount. So that is what's called, if you don't have that in a retirement account, right? So let's just say you just owned it in your LLC or personal name. That's going to be discount income. That's how that's going to be classified. And that portion of the income is going to be either short-term or long-term capital gains based on how long you held it. Now, just to clarify, none of that happens if it's in a self-directed type of account that's tax advantaged, right? That would just be totally in your benefit. So there's no UBIT, no unrelated business income tax. And the reason for that, well, one of the reasons is you're not using any leverage, right? So you are buying at a discount or doing certain things, but you're not using leverage. And so that's one of the advantages with this. Some basic things to avoid. Now, obviously, there's a whole host of things around the due diligence that we could talk about, but some things to avoid today is, in my opinion, loans secured by raw land. Now, I have some partners that, well, not partners, but individuals that I know, friends that do invest in raw land. And that makes me a little uneasy unless it's very close to where I live, just because, you know, it's a little bit more speculative. People are going to walk away from raw land a little bit easier than walking away from their house, right? Loans that are under collateralized. So that just means there's not enough equity in the property. Should the borrower stop paying and I need to actually foreclose and do all of that? Like we talked about, that's very rare. It's a fraction of the percentage of the time, but you always want to be thinking ahead as how am I properly secured and how will I deal with this if things don't work out the way I want, right? So vacant properties, I'm not a big fan of vacant properties for obvious reasons. Vacant properties have a lot more deferred maintenance issues. People are not emotionally tied. We're talking about residential property. So I would avoid those as a newer investor. Unemployed borrowers, that kind of goes without saying. They don't have anything to pay you. And then variable rate loans. So variable rate loans in 2008, especially with a lot of the HELOCs and other stuff, that was kind of a fad, right? Like variable rate loans, I can get in real low. The issue with that is most borrowers, and this is both commercial and residential, it's kind of like they're never really prepared for that rainy day of when rates shoot up. And so you're kind of setting yourself up if you have a large portfolio of variable rate loans and they're longer term, right? We're not talking about like a 1 or 2 year term, but we're talking about something that has 10, 15, 20 years. A lot of times you're going to run into issues because those borrowers are not going to be prepared when rates go up like they are now. And they just may not have the funds to pay you. And so you'll be setting yourself up for issues. So fixed rate loans, in my opinion, for the most part, are a better way to go. You'll be much safer and it's just easier to sleep at night with that. And then obviously things to avoid is being rushed into a deal by a seller. If a seller is kind of pressing you, giving you a hard time, rushing you in your due diligence, those are all things that are red flags that I would avoid. You do want to be timely with them if you're buying from an individual or a third party, a counterparty, but you just want to use your own judgment on that. And then things to avoid, this is kind of common sense, anything that you don't fully understand or feel comfortable with. And no loan is perfect, just like any investment, they all have risks, they all have issues. At the end of the day, what we're looking to do is mitigate risk as much as possible and increase the upside as much as possible. So anything that you don't fully understand or feel comfortable with, that's a risk and should be something that, number one, you should educate yourself more on because these are retirement funds, or defer to someone who has experience in this field and get their opinion or advice or management. So those are the things that I would mention. Let me get some water here. So some basic recommended self-directed strategies with this type of investment class. And again, you can go all kinds of different directions. If you're hands-on, if you're hands-off, more passive. What I'm about to talk about here is simply, you're a business professional, you have knowledge of different investments, you have a self-directed with directed IRA company, and you are just interested in passive type products. So I would suggest buying performing notes only. And these can be on any type. These can be commercial, residential, whatever your flavor is, but just performing loans. I would focus, if it's residential, I would focus on higher end homes. So I would not focus on, Ohio type properties that are worth 65 grand, unless that's your specialty. I would focus on properties that are in good areas, that have solid borrowers, that are worth $200,000 or up. And what I mean by that is not that you're paying $200,000 or the loan's $200,000, but the property is worth right around that and up. And what that does is that puts you in typically great socioeconomic areas with stronger borrowers, stronger properties, if more desirable properties, if you ever have to, exit through the property, which is unlikely, but you kind of want to prepare for that. And buy loans in great neighborhoods. And that kind of goes without saying. It's a lot better to have something with a white picket fence, looks good, somebody that has emotional equity in their property. They're not just going to throw their hands up and walk off. Secured loans only. So you can actually buy loans that either have title defects or other issues where if the borrower stops paying, you can't do anything about it because it's not secured on title, or there's a title defect that can't be fixed. And so you want to focus, part of your due diligence is making sure that you do have a secured lien on title, and you only want secured loans. And then I would reduce the risk by buying in several areas. I would not buy, I live in Austin, Texas. It's great here. Everyone wants to move here. It's hot, but I wouldn't buy every loan here. And the reason for that is things could change. The wind could blow the other way. We could have issues with jobs, the government, all kinds of things. And so if you are buying more than one, I would focus on something that has a diversity in different areas. And so your money is spread out, and that helps hedge risk. And then I would compound your interest as often as you can. You can do that either as an individual investor, if your IRA owns loans. Our company helps investors do that with our products. And it's actually makes a big difference if your IRA has some time left in it. If you have several years or more, that's going to make a substantial difference in your actual overall return. And then I would consult with, or only, accept advice from folks that are professionals in that space. So number one, that have done it before at least a couple times and can explain how they've done it. And they have references and you feel comfortable with that you've done your own due diligence. So that is my last slide. What I would say is go ahead and go to our website if you'd like after this video or after this webinar. Again, our website is paperprofitsfund.com. And you can get a copy of my free book if you'd like it. We'll mail it out to you. You can also schedule a consultation with myself or with my partner, Jane, if you'd like. We have multiple different types of products for investors around this asset class. We have products tailored for growth, more aggressive growth. We have products tailored for income as well. So we'd be happy to talk with you about that and see if something like that fits your specific needs. And then if you just have general questions about the investment class itself, or notes or due diligence or anything else, feel free to reach out to us. I'd be happy to talk with you.
Thanks, Josh. Got some questions coming in. First of all, great presentation. Love the information. I've actually even got some questions of my own.
Sure.
If you want to go ahead and stop, well, give it a second so people can get your information there.
Okay.
But somebody said, can you go deeper on these loans that are for sale at a 25% discount? Why would someone invest $100,000 in a home worth $125,000, sell that loan to us for 75? I'll just leave it at that. I know there's a lot of reasons, but where are you seeing the most common reasons people will sell loans at discounts?
Yeah, so it's going to depend on the type of loan, right? So it could be like I said, I started in the second lien space, and I know that sounds really risky, but I really got comfortable with it, so I understand how to manage that vertical. You can get substantial discounts both on second and first liens, right? Senior liens. And we also do a lot of senior liens as well. The reason for the discount is going to be, like I said, the investor may have already made their money. There could be some issues where the property is not perfect. You know, there's some issues, and typically the bigger the discount, the more that's the case. Meaning, if you're looking for that waterfront property in California, and you want a senior lien and the property is worth $4 million and you want to make 15%, that's just not going to happen, right? Because the seller understands that and all of that. So what's going to happen is you're going to find that there's kind of a tipping point, a balance, a seesaw where risk versus reward. The discount is going to come into play. Why somebody would sell that is there's an open market for this stuff. And so usually they'll send these loans out to bid, meaning you and 15 other people are seeing this loan. And so there'll be bids that come out, and the seller is going to see kind of a base range of what this thing's worth.
Yeah, and I've seen instances where a lot of times you see this with some small community banks and things like that, where assets managers have to get some assets off their books to account for their less cash. They have to have a certain amount of reserves unavailable. So sometimes they'll start selling some assets off. It doesn't mean it's a bad asset. It just means they have to compensate for some of the lack of cash that they have. I've also seen a lot of private lenders. Private lenders can sell off assets, at a whim. I know a lot of self-directed IRA investors that owned notes that sold their existing notes in their IRA to other IRA owners because they got to a certain point where they were retired and they wanted to live off some of the money. And
Right.
you said it perfectly. They already made their money. They just want to liquidate some of this. They don't want to have to deal with collecting the payments anymore, even though it's been kind of easy. They want to sell off some assets. So you oftentimes see that with a lot of private lenders, and that could be with their own personal cash or their IRA cash.
Yeah, and keep in mind
assets.
too, yep, exactly what you said, Nate. Keep in mind too, that the discount in and of itself, depending on what the term is left, like you said, if somebody's kind of retired, they're like, hey, I've made my money, I just want this chunk of money. They don't want to wait another 15 years to realize that discount spread. I just want my money now. You don't know if that borrower is going to pay off early. Statistically,
they also might have another investment opportunity where it's forcing them to just sell off this asset because they want to put it into a different asset that meets more of their needs at that time.
Yeah. So it does happen. There's typically on the secondary market, there's typically always some discount. Some is small, right? It's just a few percent. I've purchased some loans that are at what's called par, which means you're buying it for no discount, right? But if the numbers still work, then they still work.
Right. Here's another great question. Do you consider whether the property is in a judicial or a non-judicial foreclosure state?
So when I started out years ago, I used to. That was like my go-to, I'm only going to do. We have done so many, it doesn't matter to me personally. Some folks do. And I will say that there are some states that we're moving away from, right? That are becoming just really litigious, really just a hassle. New York, a number of other states, I would just say, just avoid it. But I don't really discern judicial versus non-judicial because we deal with those in the same manner.
Yeah, and I would say the same, from my experience. I don't concern myself with judicial or non-judicial, but I do concern myself with what's the foreclosure process, and if the loan goes bad, how fast can I get the collateral? So that's something that you want to either understand, or like Josh said, lean on a professional that understands each state's foreclosure process. Because even if you're, sticking to, say, investment property, well, there's some states that make it really tough to get your collateral, even if the borrower, stops making payments. States like New York, states like, I've heard California can take a long time, even when the borrower stops making payments, for you to actually get your collateral and try to be made whole. but states like Texas and states like, even Arizona is a little bit easier. I know Texas is where I've had most of my loans, because on an investor loan, borrower goes into default, you can have the property in 90 days
Yeah, you
because
just come
it's
into his
just
house
very
and kick him out. Yeah.
right, exactly. And for me, and this is maybe something there was another question that came in, and this is to each individual. I mean, Josh is doing this as a business, so he's got a lot of experience in different areas. For me, I like to just loan on investment property, and there's a lot of reasons for that. And I'll
Yep.
pose this question because somebody else had this question, is with ties into it, is do you need to run your loans through a licensed mortgage originator?
So if you're going to originate them, yes.
Yes.
So and again, like we talked about, if you are creating, origination is creating a beginning new loan. Yes, you need to either be licensed yourself, which is unlikely, or have an originator do that for you. So that means typically, you're going to have an attorney or someone like that, or a loan originator that's going to do that on your behalf. Yeah.
Now, is this only on owner occupied property though? Because
That's
from
a
my
good question.
understanding, Dodd-Frank will requires for a licensed mortgage officer, but Dodd-Frank only applies to owner occupied property. So if you're loaning on non-owner occupied property, aka investment property, you potentially you don't have to run that through an LML. Consider.
I think
So
you're correct. Yeah.
yeah,
Yeah, we
yeah,
haven't done a lot of that. What I would say in addition to that is I wouldn't do it yourself. It's worth paying the extra couple
right,
grand for an attorney to do
right,
that. Because you'd
yeah,
really be surprised on how just real small tweaks to the language or the forms or something, you're like, oh, well, you're never getting this money. It's just really strange. I've seen some things where you can make mistakes. Yeah.
right. Yeah,
So an
definitely,
attorney is the
definitely
best way.
use an attorney. Yeah, definitely use an attorney, especially
Yeah.
if you're on the side of creating notes. Definitely have an attorney,
Yeah.
preferably a lender's attorney, help you, at least draft your first, several notes. And if it becomes boilerplate, you can reuse notes. Some people say never reuse notes, but always, always lean on a professional, especially to help you draft those notes. And I would say, uh, kind of just reemphasizing what Josh said, stick to where your comfort zone is. Stick to, if you're comfortable in your area, your neighborhood, that's a great way to do it, but also stick to your comfort zone on property type. I've seen lenders who do very well, loaning secured by, single family residence, 3-bedroom, 2-bath house, because they know what to do with that in the event that they end up owning it. But then they go off and they find this really good deal, and there's some good yield and spread, and it's commercial property. And then they run into the problem. They're like, oh crap, I don't know what to do with commercial property. So I don't know if you want to add on to any of that, or if you've ever seen those issues come along.
No, I think that's spot on. I think
Yeah.
this is one of those things, just like everything else, where there's a lot of avenues to explore. Stick to where you're comfortable, and if you want to explore, just take baby steps, and then also get some advice from somebody who, at the very least, an attorney or someone who's been doing it. Yeah.
Right. Here's another question that came in: Is the tax stock a K1 or is it a 1099 interest stock?
So for our investors, it is a K1. And the reason for that is because they're actual partners with us, they're owners. For your IRA, I have no idea. It's going to depend on if it's totally
Right.
if there's
Yeah,
if
I've
there's
seen
tax
I've
or
seen
not.
both. Yeah, I've seen both. But again, the beautiful part about notes, which is a little bit different than real estate, mostly real estate, you're not going to have to deal with UBIT, but Josh kind of mentioned it, is loans don't incur UBIT. So whatever tax stock you have, I mean, it's just like we sign it and send it on, but your IRA is not going to owe any tax on that because it's not an owner of property. It's not an owner of real estate that has debt on it. You can own a note. There could be other notes there. And people could argue, well, isn't a second lien mortgage leveraged? But not for the note owner on the first lien mortgage. So this is one of the beautiful parts about owning notes, is that one of the things to stay away from UBIT is loan don't own. So if you own notes, you're never going to have to worry about UBIT, especially if you're doing it, ones and twos and threes in your IRA. So it's a great investment. It's passive income. And to your IRA, it's going to be completely tax deferred or tax free, depending on what type of IRA that you use. So, Josh, anything that you want to wrap up with? Anything that you want? Any final last words? This was great, by the way.
Not that I can think of. Yeah, what I would say is, this is a very high level conversation about the opportunity. There's a lot more to it. And I would say that if if any of your listeners do have some questions, or if they are interested in a more passive approach, we'd be happy to speak with them. And I do think, regardless, that this type of alternative investment is a nice thing to feather into self-directed accounts.
Awesome. And I've got a screen I want to share. So if you just stop share, I'll just move on to that. And I don't know if anybody online was at our alternative asset investor summit, which was a great event. You know, one of the people that I really enjoyed talking to was our client, John Shikarchi. He's going to be on some programs going forward too, if you guys are interested. John Shikarchi is one of our clients. But he does a lot of different investments. He buys a lot of high-end properties. He buys some fix and flips. He buys businesses as an IRA. But he even said to me, he said, if I've got money sitting around doing nothing, I'm going to find somebody to loan that money to, or I'm going to find a note to buy, because I need to get that money off the sidelines, because the money that's sitting there uninvested is making zero. So notes is usually a good investment where, if you've built some sort of network, or you have what I call access to deals is going to get you in front of people that might need some money to buy some real estate. And again, you don't have to be the one that's always constantly finding deals. When it comes to your self-directed IRA, I know there's the self part of that. You just need to know people that have access to deals. Josh is somebody that has access to deals. I'm not saying that as a recommendation to invest with them. I can't recommend anybody, but it's good to know different avenues so that your money's just not sitting there making zero. And I think that's ultra important nowadays with the cost of living going up and things like that, is you make sure that your retirement is either keeping up or beating inflation, so that you're not losing money safely. And notes is just a great way to do that. So I want to bring up just a couple other slides here. If you guys missed something, make sure to go to our YouTube page. We'll have this the recording of this workshop up on YouTube. Give us about 24 to 48 hours. It'll be up on our YouTube page, so you can go there for more education, or if you want to rewatch this workshop. We've also got a great Learn page. If you go to our website, directedira.com, just click Learn. We've got podcasts, webinars, workshops that'll help you get more familiar with self-directed IRAs. And if you want to book a call with me to talk a little bit more about this, whether you're a client or not, I'd love to talk to you. Just scan that QR code or scan that QR code. You can book an appointment with me, or you can shoot me an email. We could talk about strategy, or how to utilize your self-directed IRAs in the best way possible without me giving you advice. And if you're interested in opening up new accounts, maybe you're a client that needs an HSA, a self-directed HSA. Maybe you have some kids that you want to open up some education savings accounts for, or maybe you're just a new person watching this and you've transferred jobs and you've got that old 401k. You're trying to figure out, what the heck do I do with this thing? If you want to set up an account and use that code for watching this workshop, RYR100, which stands for Rethinking Your Retirement 100, we'll give you $100 off every account that you open. That comes off the administration cost for the year. So we make it advantageous for you guys. We really just want to make sure that you guys understand how to utilize these self-directed IRAs and grow tax-free wealth on your terms, not the terms of the stock market. So Josh, again, thanks for having you. I really appreciate, what you've done. And I know that you've helped people retire early based on the work that you guys do in the space that you guys are working in.
Yeah, absolutely, Nate. I really appreciate, the time today and being on here. This is a lot of fun. And I appreciate all your listeners, and look forward to talking with you guys again soon.
Awesome. All right, guys. Well, if you're interested in registering for the next workshop, just go to our website, register for that one. It's going to be August 1st. We're going to be talking about creating notes. And again, thanks for attending. You guys have a good rest of your Wednesday.
All righty. We'll see you later.